And we've talked to clients about second mortgages versus HELOCs, things like that. I know I've had that conversation a million times. HELOCs have a tendency to have a higher rate of interest than do second mortgages, right? But unlike the second mortgage, you're not taking out that lump sum and then doing something with it. It's there. It's available to you. That's why it's a higher rate.
You can also pay interest only on the payments.
Correct.
And, yeah.
That is now not deductible. So that is going to have an impact on some people.
When do you think their kids are going to benefit more from their inheritance? When they're 40 or when they're 60?
Yeah, it's going to be the younger one because they haven't had as much time to build up their wealth yet.
And so it's, to me, an awesome thing to see when clients are implementing some type of a gifting strategy while they are still alive. One, they get to see the benefits. They get to see the fruits of
That's the big one to me, is you get to enjoy what your money paid for.
Yeah. Or, and you can also provide additional experiences for your kids or collectively as a family. Leave more, see the grandkids enjoy whatever you're leaving. Whatever it is, you get to enjoy the gift yourself while you're still alive. You get to see the enjoyment in your beneficiaries' faces. All right, welcome back. Thanks for joining us for another edition of the Retirement Planning Happy Hour. Eric Douglas, Chris Vaughn with Family Wealth Planning Partners. And we have, at least for me, a very extra special treat in the form of Woodford Double Oaked Bourbon. And I'll let Chris kind of talk about that here in just a moment. But the topic for today, we are going to take this one big, beautiful bill. Probably not as big as some other bills that have been run through Congress, and we'll talk about that in a second. But it is still definitely big, and there's a lot going on in regards to tax laws and changes that do affect the vast majority of our client base and the vast majority of the population, obviously. So we just kind of wanted to run through some of the highlights, maybe get into the weeds on a few things that we maybe found a little bit interesting and probably won't affect most people, but there are some things in here that I thought were kind of interesting. But with that, let's start talking about what we're going to be tasting today, because I want to start drinking it.
All right, sounds good. So for those of you who have not seen this, this is the Woodford Reserve Double Oak. Now, we did, on a previous version of this show, I don't know, 3 months ago, we did the Old Forester 117 series that was they called it Extra Old, which was their 1910. That's their Double Oak. And then they just did it longer. So basically kind of the same concept. I can tell you, having had this many times, there's a new release every year. It is outstanding stuff. Something a little bit different today. If you'll notice, there's no glass of water and a little dropper for us to cut this one, because cutting this might actually be a sin. I'm pretty sure it's somewhere in the Old Testament. This is just wrong to cut this. It is perfect.
Yeah, well, Double Oaked is one of my favorite go-to bourbons.
Right.
It's always reliable. It's not super exotic by any means, and you can pretty much find it anywhere. And what does it usually cost? $50, $60 for Double Oaked?
It's just $60, $65 now is where I usually
so
see it.
that's kind of about where my limit tends to be with anything that I'm going to buy myself. But I love it. I love Double Oaked. It's one of my favorite go-tos.
And it's very, very consistent, and it's easy to find.
Easy to find. It's fantastic. Yeah. It's delicious. I love it.
This one...
and so this is my first time tasting this one.
This one is not so easy to find. In fact, it is very difficult to find because it's sought after. We go back to what we've talked about before. Bourbons are becoming more available because the demand is dropping, but this is a product that's produced over years, so you can't just turn off the spigot, right? This one's more than $65, and I'm going to tell you that I bought this at retail, and I'm not going to say how much I paid for it. And the reason I thought about this...
You ashamed of yourself?
I'm not ashamed of myself, but basically, if you're going to be willing to pay what the retail on this is, you don't care how much it is.
Yeah.
Right. I mean, we're not talking about buying a $1,000 bottle, or for that matter, a $500 bottle. But the people who are going to be willing to pay this, that price could go up or down $50 and they wouldn't care. Right. Yep. So just be aware, if this is something that you want to try, but you don't want to spend a whole lot of money, start a podcast with one of your buddies who's willing to bring their stuff in, or just, go when you get an opportunity to go to a friend's house and have a bourbon event. Make sure you take advantage of that, because I can see the look on your face. you are relatively pleased at this point.
We'll get more in depth on my review later for
So,
sure. After I had a few more sips.
A couple more things I would point out on this before we get into the tax stuff. The double is not in their normal double oaked bottle. This is the same one that they use for their Masters collection. This is a 700 milliliter bottle, not 750, and it is, in my opinion, one of the cooler bottles out there. It's got a big glass piece on the bottom. This bottle weighs a ton when it's empty.
Yeah, it does.
And it just really looks good up on a shelf somewhere. So even if you got an empty bottle, decorate it, put it out, and you won't be upset about that. All right. So we'll come back to the bourbon here in a little bit after we've been talking and enjoying it.
All right.
Where do we want to start with this?
I guess
this is a big, beautiful bill act.
Yep. And it's, obviously what are the two most interesting topics for everyone is death and taxes, right?
Yeah.
And so
and it addresses both.
So this one is about to get very heavy on the tax side. So that's another reason why we needed a good bourbon to get us through this topic today.
We needed a really good bourbon to get through the tax part, right?
Yep. So this was signed into law, of course, of all days, July 4th, 2025. It was about 330 pages. The table of contents itself is 9.5 pages long. Basically, this was primarily, brought to the table to address the tax laws that were set to sunset.
Right. Which
at
we've
the end of this
spoken
year.
about many, many times.
And we talk about that in virtually all of the conversations that we have with clients about the tax laws that were set to go away at the end of this year, at the end of 2025. And they were going to revert back to what the tax laws were
pre-2017.
At the beginning of the first Trump administration. Right. Now, the tax cuts that he put into effect back in 2017, they were set to expire. That's what these were. And so really this bill was centered around the fact that he wanted to extend and make those tax cuts permanent.
Right. Now, to be clear, there was a lot of other stuff in this bill that was not specifically tax related. Mm-hmm. But to your point, that was the real crux of what this bill is about.
Yeah. Mm-hmm.
And that's what the bulk of it is about. And we'll give a shout out. If you watch and you can see the papers that we've got down on the table here and we're reading through this. This actually was compiled by a friend of ours who is a CPA for a presentation that he did on some of the tax law changes that were in this. There are some interesting names. If you can read it, every page has a different name. This particular friend of ours is not a fan of the bill, so he kept calling it different names, and they get more and more obnoxious as we dig through it. So shout out to Daniel, who is on vacation as we are recording this.
Well, to be clear, he's not a fan of the person who
correct.
Signing the bill.
He's not a fan of the person who signed it.
But who says we can't be bipartisan here on the podcast, right? So
start with the big stuff.
Yeah. So the big stuff, obviously, the biggest, most important takeaway is the current tax rates were extended, and even more importantly than that, they were made permanent.
Right.
So one of the talking points that I've had with our clients, really since the tax cuts went into effect back in 2017, was not only were tax rates historically low, they were artificially low.
Right.
Because we were only going to enjoy our current tax rates until the end of 2025. Now I have to take away that talking point because our current tax rates now are historically low, and they've been made permanently historically low.
And full disclosure, we're glad that we're taking away that talking point because it's not one that was fun to have.
Yep, absolutely. And I will say, as it relates to planning topics, and maybe this is we're not going to get too terribly deep in the weeds on this, but when it comes to things like Roth conversions, and you hear a lot of information around Roth conversions, actually this makes Roth conversions a little bit less attractive.
Yeah, agreed.
To be perfectly honest, because one of the talking points over the last several years was get your Roth conversions done because tax rates are going to go up after 2026. Right. Well, that's not the case anymore. So if you're in your current tax bracket and you plan to stay in your current tax bracket, the talking point for Roth conversions is a little bit less. Not to say that they're not valuable, and obviously every case, every plan is going to be different. Right. But universally across the board, they're not going to be quite as effective as they were prior to the passing of this bill.
And let's clarify permanent. The old bill, as you said, it was going to sunset, and we were going to revert to the old tax law at the end of 2025. So when we say permanent, that means that this is not going to change until there is a Congress and a president who are willing to work together, and they have a desire to change it. And every new presidential administration does have a habit of looking into the tax law. So permanent until Congress and the president change it again.
But it definitely seemed to be somewhat bipartisan that there wasn't really much of an appetite to raise taxes across the board.
Correct. Yeah.
And let's be clear, if this had sunset, every single tax bracket was going to go up. Yep. I know one of the talking points that you always hear is these were tax breaks for the ultra wealthy. No. This is
across the board.
This is tax relief for everybody. This is across the board. Every single tax bracket was set to go up at the end of this year. So it's good that they were extended and made permanent, knock on wood, at least until some other new president and some other new Congress comes in and changes it. So that's cool. The standard deduction was also another big thing, and this affects everybody, obviously. So standard deduction goes up to $15,750 if you are filing as a single individual. If you are married filing jointly, it was permanently increased to $31,500.
Now, what I find interesting about that is that, and this was something new, that deduction, that standard deduction, is now indexed to inflation.
Correct.
It's Friday. I can't talk. So that's something that we haven't done historically, right? So when we say indexed to inflation, understand that there's a very specific number we're looking at. It's called the CPIU. So that's the Consumer Price Index Urban is what we're talking about. That's what they normally will use when they're reporting on the news, what the inflation rate is, stuff like that. So it's now tied to that. So each year, if you've got, say you're married filing joint, you get a $31,500 standard deduction, meaning you can take that or you can itemize, whichever one is to your benefit, not both. Now that's going to go up. Say the CPIU is, let's just say 3% is what calculates for this year. Then that deduction is going to go up by that same 3% in the subsequent year. So these are going to go up. That's a good thing in my opinion.
Yep. So no, that's awesome. Anything that is done to relieve or to provide tax relief for individuals, I'm obviously in favor of. Because that we pay too much in taxes, right?
Yep, exactly.
Really across the board. I was having this conversation with a client the other day, actually, and you and I kind of expanded upon it. We talk about we get paid income and we pay income taxes, and then we take that income after tax, and then we go buy goods and services, and we pay a sales tax, and then we buy a house, and we pay, taxes on our house, and then we go buy a car, we pay taxes on our car, and and you made the comment it's impossible to be in a less than 50% tax bracket when you add up all of the different
every
taxes
tax that you're going to pay, you're going to be paying more than 50% of your income in taxes.
So anything that provides any level of relief when it comes to taxes is I'm in favor of. So personal exemptions were permanently eliminated. They were suspended under the previous tax bill. So those were made permanent. So that's good. I'm sorry, they were permanently eliminated. Child tax credits for kids under 17 actually increased to $2,200. Once again, indexed to inflation and made permanent.
Another really cool thing, it's indexed to inflation. Now, I'm at that one. I have a 17-year-old in my house. Legally, he is not an adult, but I don't get the child tax credit of $2,200 because he's 17. I don't know why they came up with that number. Why is it 17 doesn't get it as opposed to 18? Just a little curiosity. But to your point, it's indexed to inflation. So whatever that CPIU number is, this is going to go up. Now, for those of us who have older kids or even parents who live with you who are dependent upon you, there is a different tax credit. So in my case, I've got 2 kids living in my house. Technically, they're living in my house. One of them's a college student. But they are 17 and over. I get a $500 tax credit as opposed to $2,200. So enjoy the $2,200 while you can.
I still have a few years.
And that is permanent, but unlike the normal child tax credit, it's not indexed. It's $500. So I'm going to get $500 on each one of my kids every year as long as they are still dependent and living at home.
One of the big ones. At least,
this one's huge.
At least in our world, anyway, it probably doesn't apply to most of the people out, most of the citizens of the country. But the estate and gift tax exemption was increased to $15 million. This is basically the death tax, right? So the level at which you don't have to pay death taxes or you were exempt from paying death taxes was increased up to $15 million. It is indexed to inflation, and once again, it was made permanent, because it was set to revert back to $5 million next year in 2026, which would have affected far more people than it will be now going forward.
So let's go into this one a little bit. We've talked about this before when we talked about estate planning. We talked about gifting. A lot of people are going to say, okay, so it's $15 million per person. So for married, it's $30 million. And most people are going to say, but Eric, I'm never going to have that much money to give away. Why is this a big deal? So, and here's why it's a big deal. There is a misconception that there's this gift tax. I can't give away more than, I want to say it's up to 19,000 something now, but most people have a 14,000 or 15,000 number.
It was 15. They increased it. It's either 18 or 19 now.
Something like that. But it really is kind of an irrelevant number for the vast majority of people, and here's why. So if you give money away to a family member, for argument's sake, we're not talking about a nonprofit. That's a different animal.
Yep.
When you give that money away, you can only give away that 19,000, 18,000, whatever the number is, because if you give away more than that, then it's taxable, right? And that's not true if you got a CPA who's worth their salt, right? Because what they can do is you have this lifetime exemption of $15 million per person, right? All they're going to do, your accountant, when they're filing your taxes, is going to take that, say, $25,000 gift, and they're simply going to reduce your $15 million by that $25,000. Well, now you've only got $14,975,000 left you can write off in your lifetime. Very few people are even going to approach that number. So this number does matter even to those of us who are not going to have $15 million to give away at death, because it allows you to gift larger sums throughout your lifetime.
Yeah, and that's a big point. And we talk with clients a lot about that. Yeah. I'm a huge proponent of gifting during your lifetime, specifically because, especially if you're working with clients, we run the plan and they're probably not going to run out of money, right? We do enough of those analysis, and so let's just assume that we have clients that are not on track to run out of money, and that's awesome and that's fantastic. But we're also projecting them to live to 90, 95 years old. When do you think their kids are going to benefit more from their inheritance? When they're 40 or when they're 60?
Yeah, it's going to be the younger one because they haven't had as much time to build up their wealth yet.
And so it's, to me, an awesome thing to see when clients are implementing some type of a gifting strategy while they are still alive. One, they get to see the benefits. They get to see the fruits of
that's the big one to me, is you get to enjoy what your money paid for.
Yeah. Or, and you can also provide additional experiences for your kids or collectively as a family. Leave more, see the grandkids enjoy whatever you're leaving. Whatever it is, you get to enjoy the gift yourself while you're still alive. You get to see the enjoyment in your beneficiaries' faces. Right. And so I'm a huge proponent of doing that. So this helps clients feel enabled to be able to do that to some degree.
And just to add an extra component to this, like that child tax credit we talked about, this is indexed to inflation. So $15 million, you increase that by 2.5 or 3 or 3.5 or whatever the CPIU is going to be in any given year, this number is going to get pretty big. The chances of even people that most would consider very wealthy ever approaching this number is very, very slim.
Well, and even for those, clients of ours that are affected by that $15 million exemption, this just allows more permanency. It gives an idea of, okay, the tax laws aren't set to change. It makes it a little bit easier to do estate planning under the guise of, okay, these are the rules. We know what the rules are going to be for the immediate future, as opposed to some other
change that might be coming,
being changed in the next few years. So that's good. Anything that helps to establish permanency, once again, I'm in favor of.
All right, so let's move on to the next page here, the mortgage acquisition indebtedness limit. Now, I may be misstating this one. As I understood, it's now, and he's got here on the page, it's $750,000. My understanding is that this reference refers to the interest that you pay on a mortgage being tax deductible. That is limited to $750,000 worth of debt. Yeah. So, for example, you can't go out and buy a $10 million home and finance, say, $9 million of that and then write that interest off. You're limited to $750,000 worth of debt that you can write off the interest on that.
Yeah, And most people that have mortgages greater than that, they're typically their income is usually going to phase them out anyway for being able to qualify this, and they're just going to use the standard deduction anyway. So this probably really isn't even applicable to most folks. Home equity debt.
That one is the issue, is the home equity debt. So we're not talking about mortgage debt.
Correct.
Right?
Home equity lines.
And we're not talking about second mortgage debt, as I understand it. It's home equity lines or HELOCs. That is no longer deductible. Mm-hmm. So, and we've talked to clients about second mortgages versus HELOCs, things like that. I know I've had that conversation a million times. HELOCs have a tendency to have a higher rate of interest than do second mortgages, right? But unlike the second mortgage, you're not taking out that lump sum and then doing something with it. It's there. It's available to you. That's why it's a higher rate.
You can also pay interest only on the payments.
Correct.
And,
that is now not deductible. So that is going to have an impact on some people.
Generally speaking, I typically only recommend having a home equity line of credit almost as an emergency fund, if you will.
Exactly. As an emergency fund, I think it's great for people who are up there. They don't need that. And then they don't have to keep, $10,000, $20,000, $30,000 on the sideline.
Yeah, take out a home equity line of credit on your mortgage. On your house. If you have equity built up, you don't have to draw from it, right? So it's just available if you need it.
Exactly.
What's next?
Casualty loss deduction. Do we want to go down this rabbit hole?
It's probably not going to affect most people, so we can.
So I do remember him explaining this one. It's basically when you have a loss due to a casualty situation. So, for example, if you have a very large oak tree in your front yard, and that oak tree falls over due to a storm and cuts your house in half, and we actually have a mutual friend that happened to. Mm-hmm. That is not something that is deductible unless you are part of a declared disaster area. So if you're that one random guy that, that little storm that went through just weakened that tree just enough, there's no benefit to you on that one from a deductible thing. On the other hand, if you're in, let's just say that there's a fire or a hurricane or something like that, and a disaster area is declared by the federal government, and that tree splits your house in half, that is now deductible as far as your loss. Mm-hmm. And it does say it's extended to include some state-declared disasters. I don't know what the rule is on why this one and not that one. I don't know at this point in time. So, we've had some things here in Kentucky over the years. Typically flooding. Kentucky River was way up earlier this year. I don't know that was declared as a federal disaster area. I don't remember. But I would assume that one was so bad that it would have fallen into this category. So.
It was, along with some of the tornadoes that we've had.
Yes.
Yep. Mm-hmm. This is for the gamblers.
Oh, you're going to skip to the gamblers? Okay.
Yeah, so if we're looking at the gamblers,
right.
If you have losses, only 90% of any losses, gambling losses, are deductible. So it's still limited to the winnings for professional gamblers. Losses does include business expenses. So I know this is a very subset. This is a very tiny fraction of our listening audience, people, probably, right? But I did find it interesting. But I think what's really, really funny about this, and I'm sure that this will probably be corrected, and this was what our CPA called his favorite oops of the bill.
Yeah.
So currently the law is a little bit ambiguous as to what limits were changed. But basically, if you win a slot jackpot for $1,500, for example,
right,
the casino does have to issue a W-2G. They have to issue you a tax. Basically file a tax return,
correct,
saying that you are liable to pay taxes on your winnings. But if you refuse to provide your Social Security number, they cannot withhold taxes.
Which means they can't report it to the IRS that it was you that won that $1,500.
So this is not gambling advice. This is definitely not financial advice. But as the law is currently written, and this is obviously probably will be changed at some point.
I guarantee they're going to catch this one eventually.
I'm sure somebody will bring it to their attention. If Donald Trump, if you're listening to our podcast here, you might want to take a look at this one. But yes, there is a little bit of an issue with forcing casinos to get your Social Security number.
Yep.
So.
And that was one that he got a big charge out of. So he actually had told our group, and He said if you win money at a slot machine over at what we
Over
call
at
the
the
boat,
boat,
even though I don't think there actually is a boat anymore.
Not anymore. No.
But he said if you do go over there and win money and they try to issue you a W-2, if they ask for your Social Security, just say no.
It's the one in Southern Indiana. Is that a Caesars now in Southern Indiana?
I think it's Caesars, yeah.
It's been so long since I've been.
I've never been in there. That's not really my thing, but hey, I get it.
It is funny. You're from Louisville if you say you go into the boat.
Right.
Even
there's
if
no
it's
boat.
no longer a boat,
But
right?
you can go to the Belle of Louisville, but that's not what they're referring to, right?
Well, just like you go to the old Sears building and you still go to the Summit. And
Correct.
All
Yeah,
these
that's
other
exactly right.
All these other landmarks in Louisville that don't exist anymore, right? So.
Let's hit a couple of small ones in here that I think a lot of people do. There's some miscellaneous itemized deductions that have been eliminated. Investment expenses, union dues. That's a big one here in this area. Mm-hmm. Work-related education expenses. Okay, so in our line of work, we are required to do continuing education. You cannot write that off as a personal expense anymore. I'd be willing to bet you can still write it off on business.
Oh, I definitely will be because I have to do that before my birthday. Here in a couple
exactly.
months.
We were talking about that this morning. Let's see. Moving expense deduction, most people are used to when they move. You can write that off. That is gone unless it is a military move. For obvious reasons, they're moved all the time. They don't have any choice in it. Here's a big one, I think, that we want to hit. When the TCJA, which was the original 27, the Trump tax cut, when that bill was passed, one of the concerns was that they had raised the standard deduction so high, it was effectively doubled, that charitable donations were going to suffer. People were not going to put as much in the offering plate, for argument's sake, because they couldn't deduct it anymore.
Or at least the amount that they would have to put into the plate
in order
be
to
so
exactly.
high. Yeah, exactly.
So they're just not going to be as charitable because they can't write it off. I didn't think that was going to happen. I was wrong. Charities across the board saw fewer donations come in after that. Well, they've recognized that there was a problem there, so they've made a change. So now if you are what they call a non-itemizer, meaning you take the standard deduction that, 15.7 or whatever it was, or the 31.5 for married, you still can deduct charitable donations up to $1,000 a year for single, $2,000 a year for married filing joint, in addition to your standard deduction. So I think that's probably going to be a bigger one than what we realize, but that does not start in 2025. One of the interesting parts of this bill was some of these things were retroactive to the beginning of 2025. Some of them were effective immediately. Some of them do not go into effect until the future, and this is one of them. So next year, 2026, you'll be able to write off up to, if you're married, $2,000 of charity and still take the standard deduction. So that's an interesting one, I thought.
Yeah, that's a good one. I support that one. Tax on tips. So
this was a campaign promise.
This was a campaign promise, and it was something that got a lot of press. I think it's one of those things where the verbiage around the idea, is one thing, but when you actually look at the words and the way that it's structured, it's probably not going to be that big of a deal to most people.
Right.
But no tax on tips. So it's actually limited to $25,000 in tips. Mm-hmm. It's only on specific occupations as defined by the U.S. Treasury. Yes, servers and, food service employees.
Yeah, the ones that we would typically say. And the CPA made this comment. He said that you can bet that the Treasury is going to use the more traditional things. Mm-hmm. Servers in a restaurant is the most obvious one. I suspect there's a lot of other ones that are common, like your barber. Things like that, where tipping is fairly common. And he said it was very important that they did that designation because
everybody.
He said, I would start working for tips. Yeah. Right? And by the way, your mandatory tip is going to be this amount of money, and then he wouldn't have to pay taxes. So they did have to really screw that one down tight to make sure that was not a lot of fraud there.
That no tax on tips provision also gets phased out when your income is above $150,000 as a single filer, or if you are making $300K as a married filing jointly. Maybe in Kentucky that's not necessarily a huge deal, but if you go to some bigger cities,
some higher cost of living
cities,
cities,
higher cost of living, or maybe even a higher, I don't know a better way to say this, maybe a higher class restaurant, upper class type of a restaurant.
I was thinking the same thing. the person who is working at, say, Texas Roadhouse to work their way through college is not making enough money that this is an issue. But
if you're working at Jeff Ruby's,
exactly, I was thinking Jeff Ruby's or one of the other high-end steakhouses. If you've been to those places and say you go once a year for your anniversary or whatever, it's very common to see the exact same servers because they make a very good living. You're talking about servers who might have 5, 6, 7 tables in one shift. And if you've ever waited tables, that's not a lot, but they might be making well over $100 in tips per table. And in some cases, it's hundreds of dollars in tips per table. So yeah, there's some people out there who are making big money.
Yeah, I'll use Ruby's as an example. I get there maybe twice a year, and you do see the same.
You see the same servers because they make a very good living.
No tax on overtime. This is another one. So that is up to $12,500 per year per individual. So $25,000 if you are married filing jointly. Once again, phases out if your income is above $150,000 or $300K married filing jointly. So sounds great on paper. And it's good. It's valuable for some folks, but probably not across the board going to be quite as big of a deal as maybe it was made out to be on the campaign trail.
And there's another part to this. This was one that was pointed out to us. This deduction is going to be eliminated after the year 2028. So we're only going to get this for 4 years.
And guess what happens at the end of 2028?
Oh, gee, what happens in 2020? Oh, yeah, that's right. We're going to have another election.
Oh, yeah, Donald Trump won't be in office. So, but conveniently, while he's still in office, you can take advantage of this deduction. So,
okay, so this next one was another campaign promise that it was kind of delivered and kind of not.
Well, this is a big deal, though.
Yes, it is. So this is an enhanced senior deduction. Now, the campaign promise was no tax on Social Security.
And we still get questions because it was advertised as no taxes on Social Security.
And this is when you and I have talked about this privately when this was a campaign promise. And even when they were talking about it in this bill earlier this year. And we said there is no chance. Social Security is already in financial trouble. The argument about what changes they need to make to prop it up, but nobody will do it because everybody's going to lose their minds. They're terrified. Never touch the third rail of American politics, blah, blah, blah.
Yeah. And we're probably due to have a bigger discussion on an episode about that.
That's probably a great podcast for the future. But we knew that they were not going to eliminate the tax on Social Security. No. The only true double taxation, right? But what they did was they gave an extra $6,000 deduction if you're over 65. So if you think about it, the vast majority of people who are already on Social Security are over 65 years old. You can't file until you're 62. And it is a $6,000 deduction. But interestingly enough, that is per individual. So if you are already over 65, now this, as I understand it, does not matter whether you have filed Social Security or not. So for those people who are waiting till age 69 or 70 before they file, they can still get this deduction. And it is $6,000 per person. So married couple, that's $12,000 deduction in addition to the standard deduction, in addition to the deduction that they're getting for being charitable if they are. So there's another $2,000. So it's a big chunk of money in your standard deduction now.
Yeah, so you're talking about almost a $45,000 deduction when you add in the standard plus the additional, $6,000 per spouse in a marriage if you're both over 65. So that's a pretty big deal, although it is worth noting that it does phase out over $75,000 if you're single, $150,000 if you are married filing jointly.
And
it is eliminated.
It eliminates
conveniently
2028,
and
right?
After 2028, when Donald Trump is no longer in office.
So
fancy that, right?
Yeah, that's so. It was a campaign promise that you could argue they came through on the campaign promise, but you could also argue they did not come through on the campaign promise.
Well, let's call that what's the term, a half truth, right?
Yeah,
let's call that
I like
a half
that.
truth.
That's a half truth.
I did see a stat that they were predicting about, and this is not precise by any means, but there was a stat that they were estimating around 90% of all Social Security recipients will in effect have tax-free Social Security because the value of the deduction will increase their tax liability. So technically they're still paying taxes on their Social Security, but the deduction will more than offset what they're actually paying. So probably only 10% of Social Security recipients will still be paying quote unquote Social Security taxes. But once again, that only lasts through 2028.
Right. All right. Let's take a break. I am dying to hear what you think about the Woodford Reserve Double Oak, or as most people in the bourbon world just call it, a double.
It's fantastic.
It's awesome, isn't it?
It's amazing. Yeah, it's fantastic. It's the right amount of bite, but it's smooth going down.
It's 90.4 proof, which, if I remember correctly, is the same thing as regular Woodford Reserve,
give or take. Yeah.
So it's the same thing as far as that goes.
I've got a bottle of Woodford in my office.
It's definitely a darker color, and no doubt that is from the double oaking process.
Yeah, it's a little. It tastes a little more toasted, for sure.
Yes.
But it's good.
For the most part, here's the way I would describe this. I mean, you can talk about, well, okay, I taste butter, maybe a little butterscotch. I definitely taste some cherry, things like that. You know, you've talked about how your palate is not quite that attuned. You may not pick it up. But you know what this tastes like?
What?
It tastes like Woodford Reserve on steroids. It's the same thing. It's just everything I would taste in Woodford, I get more of it.
It's oakier.
Yes, it is
more,
oakier.
Yeah, it's more toasted.
And I like that. I don't. This is not like drinking something totally different from the Woodford Reserve that you could go to any liquor store in the world and get. It's just more of everything.
You do not need to cut it.
This would be wrong to cut this.
It goes down perfectly smooth. Yeah. You don't need to cut this with anything. It's great. I like it.
This is a fantastic pour. I wish that it was less expensive.
Yep.
I suspect in the future it will be. You know, we've talked about how the bourbon industry is slowing down. So you're going to see more things like this. A few weeks ago, we did the Eagle Rare 12 year, which is another one of those. They're having to come out with some new products. I think you're going to see more of this at first. And then as there's more supply out there and it becomes easier to find and it's actually a shelf item once a year, you're going to see that price going down because they do want to sell all of it.
What I want to do is a side-by-side with double oaked.
With the regular double oaked.
With the regular double oaked, with the single double oaked, I guess. Because I haven't had that. It's probably been a few months since I've had it. I would like to see it just side by side, just to see if how much of a difference
I think
additional
you're going to get
makes.
that same description. They're going to taste the same. This is just more of a good thing. Now, when I say this is the same thing as Woodford, there's just more of it. I mean that as a compliment.
Yeah.
It's really good. I will tell you that, I mentioned that the Old Forester 117 Extra Old that they released back in January was basically the Olfo version of this. I have done a side-by-side. Mm-hmm. They're both outstanding.
Yeah.
I would go with the Olfo because it's less expensive per ounce. Right now, they sell that one in 375s, but if you figure the actual cost per ounce, that one is less expensive, so that's why it would be my choice. Unfortunately, that was a one-time release unless they change their minds, whereas this one, we get this every single year until it's sold out. It is an allocated type thing. But long story short, if you're not a serious bourbon snob, you're probably not going to pay anywhere close to the retail on this.
No.
But if you get an opportunity to drink some at your buddy's house, definitely take them up on that because this is outstanding stuff. And whatever you do, don't cut it. I actually thought about it. Instead of using a Glencairn today, I was going to try a brandy snifter, which if you've never tried different glasses with bourbon, it does make a difference. The way that the scents, hit your nose, in some cases, actually the flavor will change. I didn't believe that was true until I took a brandy snifter one time. I poured something I'd been wanting to try, and I was really disappointed. It was just not good. And a friend of mine, who is about 50 feet away from us right now, said, you know what, why don't you pour that in a rocks glass, kind of like the ones that we're using for water here. And I tried it, and it was very good in that. Because the rocks glass does not make the nose of it quite as intense as what a brandy snifter or a Glencairn does. So, final verdict on this bourbon is outstanding.
I'm a fan.
But you're going to pay for it. So, all right.
I'm a fan.
Let's get back to taxes. I feel like we're just rolling through these, and the people who are listening to this are drinking through a fire hose.
Well,
right
I mean,
now.
we've already hit the biggest things. We're kind of, there's probably one or two more bigger items. But this one's interesting. So there's no tax on car loan interest. So this was kind of advertised as a somewhat big deal, probably a bigger deal than really actually is.
Yeah. And I think the motivation here was this kind of goes back to that tariff argument.
Yeah,
this is to get people to buy domestic.
This is absolutely in conjunction with the tariffs, because up to $10,000 on the purchase of a new car, you are able to write off the taxes, or I'm sorry, you're able to write off the interest.
The interest, right.
That you pay. So there's no tax on any car loan interest up to $10,000 on the purchase of a new car. This is after 2024. So this is already in effect for 2025.
If you bought this in the year 2025.
The kicker is it must be assembled in the United States.
Right.
So it doesn't necessarily mean it has to be an American, quote-unquote, American automaker.
Right.
It just needs to be assembled in the U.S. So from a local perspective, if you're buying I happen to have one myself, a Toyota Camry, right? That was assembled over in Georgetown, Kentucky. That still applies.
So a couple of just interesting observations here. I've heard this argument since I was a kid. It's an American car or it's a foreign car. There is no such thing as a modern automobile where every single part is manufactured in one country. That doesn't exist. Mm-hmm. They're manufactured all over the world for any number of different reasons.
I think there is one exception. Actually.
I don't know what it is.
Tesla. No.
Every single component. Okay, that might be true. I didn't know that.
Yeah, at least that's what Elon says on X.
But the point here is that if you go out and you buy a Ford truck, which they make full-size trucks right here in Louisville, a lot of the components are not made in the United States. Now, a lot of them are, but they're not made in Louisville, right? What this is referring to is final assembly. So to your point, there are a lot of General Motors and Ford and Chrysler products that are marketed as domestic cars, but final assembly is not in the United States. And there's a lot of them actually, for many years, it was considered domestic if it was assembled in Canada. Well, considering our current tariff situation with Canada, I'm pretty sure that one's going to be disqualified. But there's also a lot of cars that we would consider to be foreign cars that are very much assembled in the United States. You know, the Toyota Camry that you referenced, that's a great example. That's made right here in Kentucky.
There's a big Hyundai plant down in Alabama.
Yeah, there's a Hyundai Subaru plant in Indiana, BMW, Mercedes. They all have U.S. assembly plants for certain models.
Correct.
So it really depends on which model you're buying. I will tell you, if you want to know, I'll teach you a little trick. Look at the VIN on a car. The very first digit tells you the country of final assembly. And if it's built in the United States, it's a 1. So it's easy to remember. It is if the very first number in your VIN is a 1, that is a U.S., although I believe Canada was included in that at one point in time, so I may not be totally right. If you see a 1, let's say this. If you don't see a 1, that's bad.
It was not made in.
That's not going to work on this one, right? Now, the other part that I find interesting, I know that people are all over the place when it comes to financing vehicles. You and I are both believers in paying cash, so we wouldn't be able to take advantage of this, right?
As rates stand today, now I still have a loan on our van, because it's below 3%.
Okay,
but we bought it a couple of years ago, and I just kind of refused to pay it off because I look at the percentage of what my payment is, and I owe next to nothing on it at this point.
No, I get that, and what I thought was funny on this, people who are, let's just say, moderately sophisticated when it comes to finances, not geniuses, just moderately sophisticated. They're probably not going to have interest of $10,000 in 1 year. They're not going to be able to take the full advantage of this. Yeah. And certainly most of the cars that are that expensive are not going to be domestically produced. And supercars, for example, like the Italians and the stuff like that, that's what pops into my mind. But one of them popped into my mind because I know a few people who own one. I know that if they finance the bulk of that car, they are going to have more than $10,000 in interest, and it's made right here in Kentucky. So for those guys who are buying these Corvette C8s, God forbid they're buying the Z06s and the ZR1s and stuff like that, they're going to be able to take advantage of this. Good for them. However, remember, subject to that phase out.
It was interesting. Right? Yeah, subject to the phase out here of 100K single, 200K married, filing jointly.
And once again, eliminated after I'll give you one guess, 2028,
after
right?
2028 when the new president comes in. Absolutely. But it is interesting. I saw a chart of the best-selling models. Mm-hmm. This is a little bit of a shout-out to our hometown here in Louisville. There's the best-selling models of cars, the Ford F-Series. Number
one. Surprise.
Number one.
And it's been that way for as long as I can remember.
Yeah, and it wasn't even really that close. But in the top 5 was the Camry. So two of the top 5.
No surprise there either.
2 of the top 5 were made in Georgetown. And actually the RAV4 with Toyota was in the top 5. And they're actually retrofitting the Georgetown plant. If I remember correctly, they're retrofitting the Georgetown plant to be able – they're going to start assembling that in Kentucky as well.
Really? Did not know that. So I would assume that it's not 100% of RAV4 production is going to be there. It's just going to be some of them?
I think it's going to be a lot.
Really? Okay, I did not know that.
There's a client over there, and he told me it's been I don't remember the exact details, but I know they are retrofitting, and they're going to start assembling the RAV4. They're actually redoing the plant.
Good for them. That's awesome.
And part of that is because you've seen, well, this is going back to the tariff conversation, so, there's I'm not going to make an argument for or against, right? This is, but just saying it's interesting how the state of Kentucky has been kind of a somewhat big beneficiary, knock on wood, so far of the new tariff policies, because we just had an announcement this week with GE Appliances.
Right.
They got a lot of money coming in, and GE Appliances is headquartered here in Louisville. So that's a huge deal. But the Toyota plant, the Ford plant, they both announced additional investments.
Yeah. Good. That's fantastic.
And so that's a kind of some major industries here in the city of Louisville. So that's a big deal.
Okay, let's move on to our next one. This is not going to affect as many people. I wish that it did affect more people, and that is an adoption credit. So if you go out to adopt, anybody who is listening or watching knows adoption is extremely expensive. And now you can get a credit for $5,000. Now, anybody who knows what a credit and a deduction is, they are not the same thing. A credit is considerably more valuable than a deduction because a deduction, you figure up what your adjusted gross income is, and then you get to take the deductions off. So you get partial credit, if you will. But a credit, on the other hand, they used to call it above the line on the old tax form. It dollar for dollar reduces your income, and then they calculate the tax on it. So this is a $5,000 credit. It is refundable, so you're going to be paying it. And then when you file your taxes, you're going to get that back in the form of a refund. And that is another one that is adjusted to inflation. So with each year that CPIU comes out, this $5,000 is going to go up. And I think that is fantastic.
Well, to your point, though, that's still not enough.
No, it's not.
Relative to the adoption process.
That's a fraction of the cost of adopting a child. But you know what? It's a start.
It's a good start, and I absolutely endorse it. I wish it was a little bit bigger, but that's just more for, that's more of a reflection on how difficult it is to actually go through the adoption process in the United States. Yeah. I don't think a lot of people realize because it's so difficult in the United States, that's what drives people to overseas.
Right, absolutely.
To bring home kids. Which is great too. But.
529 plans. So for those of you who do not know exactly what they are, 529 plan was originally designed to help your child, your student, pay for college. Well, a few years ago, they expanded that to include pre-college. So if you were going to send your kids to a parochial high school here in Louisville, where we've got some great ones, you could use 529 money for that purpose. And they also expanded it to include non-college secondary education.
I'm glad you clarified because it's not just high school; it's grade school as well.
It's not. So trade schools, for example, if you've got 529 money and you want to go to electrician school or something like that, you could use that. They've expanded it again, and it now includes qualifying post-secondary credentialing expenses. Specifically, he put down a hint: the CPA exam and the bar exam. So you say, okay, so that's for CPAs and attorneys. Well, why do they get that special treatment? He said, well, let's remember, who writes the laws? Primarily CPAs and attorneys. Although, I ask in our particular situation because in our industry, there's lots of credentials out there. They are not cheap to go get in many cases. But you can now write those expenses off. Those classes that you have to take are now an expense.
And this is across industries too. So if you're looking to get some nursing credential or,
I suspect
psychology
that would
credential,
absolutely be. I don't know if that's a credit or a deduction, but I would definitely talk to my CPA about it if you're planning on doing it or if you did it.
Yep. So the next one, this is the new, I guess they're calling it the Trump accounts. I don't know a better term.
Our CPA, who is not a fan, loves that name. I say that very tongue in cheek.
Yeah. But it's basically for newborns, right?
Right.
And so when you have a new child, you can make you get $1,000 credit for opening one for your kid that was born between January 1st of this year, 2025, through December 31st of 2028. Once again,
there's that number again.
Coincides with the Trump presidency, right? There are no deductions on contributions, although you can contribute up to $5,000 per year. Taxes are deferred on the growth. So it's a tax-deferred growth vehicle, just like an IRA. You cannot withdraw it until after 18. So it's not necessarily a retirement account, but it's for the benefit of the kid, of the child. So it's a tax-deferred. It's almost similar to a 529 plan, except instead of being limited to education expenses, it's for anything.
So the $1,000 credit that the government's basically going to give you, that's for those kids that are born in that year. But you can contribute up to $5,000 a year into these accounts as well. What's interesting, I don't like the fact that they're calling this an IRA. And the reason that is the R in IRA stands for retirement. To your point, this is definitely not specifically for retirement. The taxes, okay, so you don't get to deduct it, which suggests Roth, right? However, when the money comes out, you do pay taxes on the growth.
As it's withdrawn.
As it's withdrawn, correct. So that's not like a Roth. So this is not an IRA. I don't like the terminology. I love the concept. I think this is great. But I do think that they need to come up with a better name for it. But yeah, this one is new. So if you have a young child, you definitely want to take advantage of this.
So yeah, it's interesting. It's cool. Something a little bit different. So I'm a fan.
Yep, absolutely.
SALT limit, state and local taxes. This is a little bit wonky. Most people.
Yeah, and most of the people in this region of the country, this doesn't really apply. So
yeah.
This was actually one of the more contentious parts of getting this bill passed, where they couldn't seem to get enough votes on the Republican side of the aisle, and it was because they were looking for a bigger deduction on some of the large state taxes that you're paying. So, okay, Kentucky, you're paying, 4% now? I think Indiana's 6%.
It's scheduled to go down next year.
Right, and scheduled to go down again in Kentucky. That's not true in places like New York or Illinois or California or Oregon, where you have a much, much higher percentage income tax on state income taxes.
And local.
And local taxes, that's right. So that's what this one really applies to, is being able to write off a certain amount of your state income taxes as a deduction on your federal. So not really a big deal in this area.
Yeah, so that increased from $10,000 to $40,000 starting this year, $40,400 in 2026, and indexed to inflation thereafter. In 2030, it reverts back to $10,000. So this is temporary. This is not permanent.
Right.
So. But once again, probably not going to affect too terribly many people in our area.
Energy credits. This is a big one. So for years now, you have been able to buy I hate this phrase, a green vehicle.
An energy compliant.
An energy
or whatever.
compliant.
Yeah.
Okay, you can buy a battery-powered vehicle. You mentioned Tesla a while ago. There's quite a few of them out there now. You've gotten a credit, and it has fluctuated a little bit. You've gotten a big credit by buying that. And the idea was to push these vehicles into the market. They're not cheap, but they were cheaper because you got this big credit. Well, that is going away. So the used clean vehicle credit and the clean vehicle credit, so new vehicles, that goes away on, listen very carefully, September 30th of 2025. The advice that the CPA gave was, if you're planning on buying a Tesla or a Rivian or whatever some of the other models that are out there, if you're planning on buying one in the immediate future, you need to get on the stick. Because as of the time we're recording this, you've got 45 days. So you better get that done or you're going to lose that credit. Interestingly
45 days exactly, actually.
Yeah, exactly. The home improvement credit and the residential clean energy credit. So, for example, if you install, energy efficient windows in your house, you get a credit. I did that last year and I took advantage of it. But that goes away as of the end of this calendar year. So, end of 2025. If you are thinking about purchasing, say, replacement windows on your house or something that's going to make your home more energy efficient, if you were planning on doing it now, you might want to go ahead and get on with that, or you won't be able to take advantage of that. I will tell you that those are missold a lot. People who are selling replacement windows comes to mind. They'll talk about this wonderful energy credit you get. A lot of the people that think they're getting a credit don't actually qualify. So before you make that kind of a purchase, consult with your CPA. Will this actually qualify? So that you don't get a really nasty surprise on that one.
What's interesting when it comes to these types of credits, now that they're being eliminated, it's going to be interesting, and I would bet money on the fact that you're going to see some of these products decrease
in price.
Yes,
I would agree with that.
Because whenever you have government subsidies propping up some type of a market, that usually increases the price that you're having to pay. Same thing applies to the electric cars. The quote-unquote clean cars, right? Teslas, et cetera. So I would be willing to bet that some of these energy-efficient windows and appliances and some of these other things, I bet you're going to see some of the prices drop on some of those.
So that's one of those things where, once again, if you're thinking about doing it now, we know this credit's going to go away the end of this calendar year. Talk to your CPA before you do it. Make sure that you're going to qualify. Because if you don't qualify, Eric, to your point, and you wait until next year, you might be able to buy the same thing cheaper, right? And personally, would you rather pay more for it and get a credit, or would you get it cheaper? Well, which one's going to be a better deal? That's the way I would go with that.
Yeah, I know another example, HVAC systems.
Yes, exactly.
I remember talking to my HVAC guy a couple of years ago, and he said some of these prices have gotten so insane because of all these loopholes that they have to jump through to build these, energy compliant HVAC systems that aren't really necessarily any better, but they just have to meet some standards. So I think you could see some prices come down in some of those areas, which I think would be a good thing, hopefully. Knock on wood, right?
Yep.
Anything else to add about the one big beautiful bill here?
Well, okay, so one thing that I would point out was everything that we talked about involved your personal tax filing. This did not involve business taxes. That's a whole nother presentation. It's one I don't particularly want to get into. So if you're listening to this and you're a small business owner, for example, keep in mind we were only talking about the personal side. There's a whole different set of rules that would apply to the small business or even large business owner for that matter. So make sure you consult professionals when you're making those decisions and to learn that stuff.
But directionally, it was providing tax relief.
Yes.
So
you know what? We've discussed this. You and I are not 100% in agreement on some of the stuff that was in this bill, although we're pretty close. But I think overall, the tax part of this bill, they got that right. It was so important.
Oh, my bigger issue was around the spending in the bill.
Yes, and we agree that the spending was too much.
Yeah, the tax stuff in the bill I'm a fan of.
Yeah.
And they could have just written a separate bill, but that's a whole other.
And you know what? They had that argument. Should there be two bills or one bill? And, that was one of the things that caused it to be difficult to get through. And it also made it contentious on the parts other than the tax relief.
Yeah.
So,
but that's a whole other podcast discussion around the inefficiencies of Washington, D.C., right? So
yeah, if we go down that road,
we need a few more.
We're going to need a few more drinks.
Of this, right? But all that being said, so fantastic bourbon, good discussion on the one big beautiful bill and how it should potentially affect you, because it will affect everyone, right? And whether or not you're a client of ours. If you are not a client of ours, we would love to have you come in and discuss with you how this could potentially affect you and some of the things that we are doing from a tax planning perspective to help alleviate or mitigate any of the tax consequences that you might face in retirement as you are building out an income or spending plan. So please feel free to give us a call. The contact information is in the show notes, whether you're watching us on YouTube or listening to us on podcast. Thanks for your time. Thanks for the bourbon. See you next week.